Is this a banking crisis? Is this financials in turmoil? Is this banking crisis 2.0? What would you call what we've been seeing happen?
In the US, where some of the world's leading money managers are warning the collapse of another American bank could lead to a credit crunch and an economic slowdown.
Everybody knows inflation is still running too high.
Are you ready to dive into the world of recessions, interest rates, and I know it sounds like an economics textbook, but trust me, this is a story full of surprises, twists, and turns. So buckle up, because we're about to embark on a journey through the current state of the American economy, exploring how we got here, the various factors at play, and what might lie ahead. In response to rising inflation, the Federal Reserve decided to act. Between 2022 and May 2023, they hiked interest rates from 0% to a staggering 5%. This move was designed to curb inflation by making borrowing more expensive, thus decreasing demand and easing pressure on prices. However, such a drastic increase in interest rates had far-reaching consequences, sending shockwaves through the economy. Let's say you have a variable interest rate on your mortgage. A sudden hike in interest rates means your monthly payment could increase significantly, leaving you with less money to spend on other things. Multiply this effect across millions of households, and you get a sense of the impact these rate hikes can have on the economy. As the saying goes, actions have consequences. The higher interest rates have stressed the banking systems to the point of failure. Banks found themselves facing increased defaults on loans and a decrease in new lending activity. This led to financial institutions like Silicon Valley Bank and some other banks collapsing. It's like a domino effect. One event sets off a chain reaction, leading to unintended and far-reaching consequences. Think about how the failure of one bank can impact the entire financial system. If Bank A collapses, it may not be able to pay back the money it owes to Bank B. In turn, Bank B may struggle to meet its own obligations, which could cause it to fail as well. This chain reaction can destabilize the entire financial system, like what happened in 2008. With banks collapsing and interest rates soaring, the housing market and stock market were not spared from the chaos. Housing prices dropped by 10% as fewer people could afford to buy homes or refinance their mortgages. Meanwhile, some experts predict the stock market will drop by a jaw-dropping 60% as investors grow increasingly wary of the unstable economic climate. It's like being on a roller coaster without a seatbelt, with twists and turns leaving everyone feeling uneasy. Imagine if you bought a house for $300,000 and suddenly its value dropped to $270,000. That's a pretty big hit, right? Now imagine the same thing happening to the entire housing market. Similarly, if you had invested $10,000 in the stock market and it dropped by 60%, you'd be left with just $4,000. Ouch! And of course, no economic crisis would be complete without the tech industry taking a hit. Layoffs in tech have started, and the impact is widespread. Tech companies, once seen as a beacon of innovation and job creation, now find themselves struggling to stay afloat amidst the economic turmoil. Startups that relied heavily on debt to fuel their growth are particularly vulnerable, as they face higher interest rates and reduced access to credit. Consider the once thriving Silicon Valley, home to numerous tech giants and startups. The current economic situation has led to layoffs and businesses closing their doors, leaving many people in the tech industry scrambling to find new jobs or reevaluate their career paths. But wait, amidst all this chaos, some economists argue that growth is picking back up and wage gains are finally outstripping price changes. Could this be the glimmer of hope we've been waiting for? As businesses begin to adjust to the new economic landscape and the labor market tightens, we may see wages rise faster than inflation. This could help alleviate some of the financial strain on households, potentially kickstarting a cycle of economic recovery. Imagine a scenario where your salary increases by 5%, but the cost of living only goes up by 2%. You'd have more disposable income to spend, save, or invest, which could help stimulate the economy. Unfortunately, it's not all sunshine and rainbows. The immediate concern is a potential credit crunch. As banks become more cautious and lending standards tighten, it becomes increasingly difficult for businesses and individuals to access credit. This can have a ripple effect on the economy, stifling growth and making it harder for companies to expand and create jobs. Think about when you're trying to buy a car and you need a loan to finance it. If the banks are experiencing a credit crunch, they're less likely to lend you that money. This can have a ripple effect on the economy as people struggle to finance major purchases and businesses face difficulties in securing loans to invest in growth. So, what's next for the American economy? Will it rise like a phoenix from the ashes? or are we in for more turmoil? No one has a crystal ball, but we can look at the data and make some educated guesses. Some economists remain optimistic, pointing to factors such as technological advancements, a shift toward renewable energy, and the potential for new industries to emerge. Others warn that high levels of government debt and ongoing political uncertainty could pose significant challenges for the economy in the coming years. The truth probably lies somewhere in between, but one thing's for sure, the road ahead is anything but predictable. And now, for the grand finale. What should you, the viewer, do in the face of all this uncertainty? Well, we're going to recommend the most boring, yet effective approach to investing: low-cost diversified index funds. That's right, folks. Putting all your eggs in one basket is a risky business, so it's best to spread them out. Think about your friend who invested all their savings in that hot tech stock, only to see it plummet. Now imagine if they had invested in a mix of stocks, bonds, and other assets. Their losses would be much more manageable, and they'd be in a better position to weather the storm. And there you have it. The American economy is going through a rough patch, but no one knows for sure what the future holds. Will we emerge stronger, or will we continue to face challenges? Only time will tell. In the meantime, remember to take a boring, diversified approach when investing because, as we've seen, no one knows what will happen in the market. If you found this video helpful, please give it a thumbs up, share it with your friends, and subscribe to our channel for more exciting journeys into the world of economics. And don't forget to leave your thoughts and questions in the comments below. We'd love to hear your perspective on the current state of the American economy and your predictions for the future. Until next time, stay curious and keep exploring.